So when I was living in Costa Rica, I had a language training company, and I learned from this guy named Jay Abraham about the lifetime value of a client. Called it LTV. Well, that has a completely different meaning in real estate lingo. But when I crunched the numbers, I realized that a client for my corporate language training company was worth $12,000 to me over the lifetime of our working relationship. And at that time in Costa Rica, Central America, that was like big money. I was like, holy crap, that's awesome. And when I clued into that, then I understood how much time, effort, and money I should put into bringing on new clients.
There are millions of real estate investors out there, and most are stuck with just a couple of properties. They want financial freedom, but their small portfolio ends up costing them more in time, effort, and money than it's worth. Getting out of the rat race seems harder than ever. This show will help you do more deals, better deals, and bigger deals. Finally, you'll be able to reach your income and lifestyle goals. How? By attracting and leveraging private money partners and their capital. Now get ready to raise more money, because here's your host, Dave Dubeau.
Well, hey, it's Dave, and today I'm going to share a special episode with you. It is a piece of an interview taken from when I was speaking with Michael Ponte for his Savvy Investor Group and his Savvy Investor YouTube channel. We had a lot of fun. We covered a lot of ground between the two of us. We got a lot of experience with this stuff. So I thought I'd share this with you today. I hope you enjoy it. Over the years, I've interviewed over 360 successful real estate entrepreneurs from around primarily North America, from around the world as well. Yeah. Every single one of those successful ones has used other people's money to grow their portfolio. That's basically, that's the bottom line. And actually, Michael, this around now might be a good time to show people visually what an impact even one investor can have on their bottom line, not just their cash flow, but their net worth over time. So we talked about this earlier about having a little bit of fun with math, and don't freak out, you guys. I'm not a math guy, but this is profitable math. We're going to love it. I'm going to show you, if you're up for it, Michael, show people what the lifetime worth of an investor is to them. And before I do that, I'm just going to share my story about how I figured this out. So when I was living in Costa Rica, I had a language training company, and I learned from this guy named Jay Abraham about the lifetime value of a client. Called it LTV. Well, that has a completely different meaning in real estate lingo. But when I crunched the numbers, I realized that a client for my corporate language training company was worth $12,000 to me over the lifetime of our working relationship. And at that time in Costa Rica, Central America, that was like big money. I was like, holy crap, that's awesome. And when I clued into that, then I understood how much time, effort, and money I should put into bringing on new clients.
Right.
And by understanding that, none of my competitors understood that. I was able to grow my little company from the bottom of the pack to the top 3, and we had 50 competitors. So, and I did that in about 2.5 years. And a lot of that was just understanding that number. Now, fast forward, whatever it was, 15 years, and I'm starting to do real estate and I'm starting to raise capital. And I was doing single family homes. I was doing a rent to own strategy. So kind of a short-term thing, 2 to 3 years. And I thought, hey, why don't I apply this to see how much an investor is worth to me over the lifetime, right? Because my investors are one of my clients in that business.
Yeah.
And I crunched the numbers. And as far as I know, I'm the first guy that applied this to investors in real estate investing. And the number was $120,000. And I went, holy crap. There I was 10, 15 years ago, thrilled with $12,000 in that business. Fast forward, here I am in real estate. It's 10x the value.
Yeah. Nice.
And that blew my mind. That's why we're in this business, Michael. We're not flipping burgers. We're not in a very transactional thing with low margins. We're in a high margin business. So I've been teaching and showing people this for years. I just recently got off my rusty dusty and created a little calculator, which makes it a lot easier. So let's see if I can pull that up. You might have to give me permission there, my friend.
Yeah, let's do that. I hope everybody can kind of see this right now. It looks like it. So. Yeah. Looks cool. Cool.
All right. So, Michael, are we okay using either an example? I think you were talking about you've got a student that's going through something right now. So we won't mention any names, but we'll use the numbers and kind of fill in the blanks here. So first of all, what kind of a deal is it that this student is working on?
Yeah, so this one is a multifamily deal. I don't want to get into too much details because this is their private deal. But for them, they're purchasing, or the average price, what they're looking for property, asking price currently is about $800,000. So that's what they're working on right now. So it's a multifamily deal. It's one of the students that I'm coaching to help support them in purchasing multifamily properties. This is actually their second multifamily deal. Okay.
Awesome. So it's a long-term buy and hold. Can we use a 10-year time frame?
Yeah, 10 years. 10 years is perfect. That's exactly what it is. Yeah.
All right. Are they getting a discount on this deal?
They are. Yeah, they were able to acquire this property at about $725,000. So
$75,000 off. Well, that's close enough. All right. So we'll say they're getting a 9.4% discount. So they've created $75,000 of instant equity. Now they're not seeing that at a profit right now, but that does count towards their net worth and the total value of the deal here. All right. So down payments and all that kind of stuff. What are we looking at there?
So we're looking at 30% roughly in that vicinity. Yeah.
30%. All right. So approximate mortgage rate right now?
Let's keep it at around 5%, somewhere in that vicinity.
5%. Okay, very good. 25-year amortization or 30? What do you think it is?
Yep. 25 years.
So here's what we're looking at so far, you guys. So they got instant equity of $75,000, and over 10 years at 5%, they should be paying down their mortgage by about $144,000. Does that look about right, Michael?
Yeah, that sounds right.
Okay, very good. Now, are they going to be doing some improvements on the property and increasing the value of the property?
They are, yes, for sure. Yeah.
What's your best guess on what that's going to look like?
It's probably close to around 10%, somewhere in that vicinity.
So they're going to be increasing the value about 80 grand?
Yep, that sounds right.
Of whatever they put into the expenses for doing that, right?
Mm-hmm.
Excuse me. All right. So there we go. We got forced depreciation of $80,000. Now, conservatively, what do you think the monthly cash flow is going to be on this once they stabilize the property?
Yeah, we're looking at about $825, somewhere in that vicinity after the refi. So
$825 a month?
Yep.
Let's just say 800 to be conservative.
Sure.
So over a 10-year time frame, we're looking at about $96,000 in cash flow, correct?
Yes, for sure.
All right. Now, market appreciation, we want to be conservative, but we want to be realistic as well. So on average, over a 10-year time frame in Canada, properties tend to go up about 3% a year. Is that okay, or is that too high? Is that too low?
I think we stay conservative again in this particular case. And I think this is good for a lot of investors too. It's just, you know what? It's just a number. But if you stay at 2% over a 10-year time frame, for sure, because I would take into account the first 2 to 3 years right now, probably not a lot of appreciation, right? So
yeah, but if they had bought it 2 or 3 years ago, what would they have looked at?
Yeah,
exactly.
Yeah.
So again, it's cyclical, but let's be conservative. So this is exceptionally conservative, 2%. All right.
Yep, I'm good with
that.
So
looking at the numbers here, we got instant equity, 75 grand, mortgage pay down 144. We're forcing up the value by 80 grand, cash flow 96,000, market appreciation again over 10 years, 192,000, which is pretty reasonable on an $800,000 property.
Yep.
Okay, cool. So total profits over the 10 years, theoretically, if all of this adds up, should be about $588,000. Does that sound about right?
It does. Yep.
Okay, so is your student going to be bringing on money partners, joint venture partners?
They will. They will have 3 partners involved in this acquisition.
So what's the profit split going to be approximately?
So there is an arrangement here where they get 35% of the deal, and they get 35%, and the investors get 65%.
So your student gets 35%, and his 3 investors between them get 65% of the profit.
Correct. And there's quite the structure, just for people that don't know. This might be new for them, but we teach things a little bit different in the multifamily space. So for those that don't understand this is new to them. It's a different way when we approach it in the multifamily space. So don't get all caught up. It's like, why isn't it 50-50? There's a reason for that.
Yeah, exactly. The bigger the deal. Yeah, no, and I've done deals, Michael, where it's been 70-30 and the investors, the bigger, and I'm sure you've seen that, the bigger the deals, the bigger the syndication, the lower the percentage to the active partner, the bigger the percentage, because you just have to make it worth their while.
Yeah,
but even so, we're looking at a $200,000 profit to your student over 10 years. It's not all up front, with none of their own money in the deal. Is that correct?
Not bad.
Any
Yeah,
bet.
looks pretty good.
That's better than flipping burgers at McDonald's.
Yeah, I would say so. Mhm.
All right, now let's figure out what the lifetime worth of an investor is for this student. So their average profit on this kind of deal is 200 grand, 205 grand over 10 years.
Yeah.
How many investors do they need to do this kind of deal? You said 3?
Let's say 3. Yep, it's 3 in this one.
And let's take into account repeat business. So conservatively, if your student does a good job and his investors are happy with how things are going, how often do you think they will reinvest with him or her in future deals? Conservatively.
Yeah, like realistically, it's normally between 2. It's about 3-time turnover is normal, and especially when you've done a really good job with your money partners, they're happy to flip that over and over again, right?
So. All right, very good. So needs three investors to do a deal like this, but they're probably going to do 3 deals with them over time. So far, an investor is worth $205,000 to your student. Now, we also have to take into account referrals, because our investors know other people with money.
Absolutely.
Right? So we do a good job with our investors, and we're proactive about seeking referrals and testimonials and things like that. We can get introduced to their friends and family who also have money, and we can get those people to invest with our deals as well. So what would you say would be a conservative number of referrals?
Well, let's have some fun with it. Let's just say it's 1. And you know what? I think that's actually low, right? Because,
Good.
Normally if you do a good job, but let's keep it simple and let's just keep it realistic, right? So
there we go. So that means that each one of those investors over time will probably refer 1 more investor to them. So we've just doubled the value of our investors. So the lifetime worth of an investor for your student in this kind of deal is $411,000. No, $877.
Yeah, amazing.
It is pretty amazing. I mean, think about it. The average Canadian income, average household income, last time I looked, was just over 65 grand. So how long would it take the average Canadian family to create $411,000 of wealth? Here's the answer. Probably never, right? Unless their own house equity. That's about it. That's the only way this is what one investor is worth in this scenario.
What a great example, and a great answer to that question is, why? Why bring in money partners, and why bring in capital, or why do you do private capital raising when you see these types of things? And again, we're just talking 1 deal. And again, if you're doing multiple deals in this type of fashion, you can see where the value really starts to kick in. And again, why we are involved in this game, because you see how it compounds like this. So great. This is awesome, Dave. Really, really great.
Now here's the other kind of mind-blowing thing. Our investor is worth $411,000 to us. Well, guess how much we're worth to those investors?
Yeah.
We have to take the referrals out of there, but we are worth $205,000 to each one of those investors by bringing them on board with our deals. This episode is brought to you by MoneyPartnerFormula.com. Our Money Partner Formula service allows you to raise all the private capital you need to do all the deals you want while we handle the hard stuff. We offer reliable and affordable done-for-you marketing services that get you investor meetings booked without all the work. So go ahead and check out the website right now, and then feel free to schedule a call with me, and let's take your portfolio to the next level. Again, that's MoneyPartnerFormula.com. Watch investor meetings pop up in your calendar. We handle the rest.